All right, guys. Well, welcome back for another video. There's certainly a lot to talk about today. We've seen a lot of volatility surrounding the CPI data release. If you guys have been following the markets, you know that the government CPI data came out this morning, 7:30 my time, 8:30 New York time, right around the New York Open, and that contributed to a lot of volatility. We can go down and look at that. In the lower time frames, this is just a broad market overview, just to kind of illustrate the concept that we are going back down to support, and then you have these areas of significance down here. I will mark these off. These are more than just lines on a chart. We have the FOMC from September here, the Q4 quarterly open right here, the CPI data release right here, all coming in as price is at a historical level. If you guys aren't familiar with this, we'll just zoom out very, very quickly to the weekly. This level is your previous all-time high from right here. Now I'll go back to the 4-hour, kind of look at, kind of drill down to these levels. So first of all, let's just talk about what happened today, right? You had the CPI come out right here. This is, volatility's drying up. You get your data release, and then runs down from the lows, running just below these lows right here, right? So these are the lows created by the CPI. Not the CPI, I keep saying that, but the FOMC data release right here, and you run just below that. Notice how it runs just below these lows right here. So how many people had their stop losses right below there? So you can see this on TradingView. If we go to this candle right here, this low on Coinbase is 18,153.13, and this one right here is 18,131. So it goes just $20 below this previous low right here from FOMC, and then rockets up. So you can imagine that a lot of people had their stop loss orders below here. They got taken out before price moved up very aggressively. That's very painful, of course. Say you were long right here. You had a stop loss below here. Price runs down this fast, tags your stop loss, and then rallies up extremely aggressively. That's very painful. We've all been there. But that's kind of how the market operates. It's very brutal at times. So anyway, we have this CPI data release, and this is really a bottom formation right here. This is very classic stuff, right? I mean, the market generally whips around, at a high time frame level, like we marked off here. I didn't really go into incredible detail of why this is an important high time frame level, but if you guys have been following my previous videos, you know exactly why this level is very critical. And this type of whipsaw pattern is very common around a high time frame level. Basically, what you have here, what I just talked about, is you have people getting stopped out. Of course, if people are extremely over leveraged, they got liquidated on this move down. And then, maybe if they were short, got liquidated on the move up. So you're seeing an expansion of volatility around a high time frame support following a major capitulation in the Bitcoin market. So that's all signs indicating that, the market has bottomed and the market is creating a bottom, right? And this is the phase of the market where, if you are bearish and you see this happen, maybe you're kind of wishing now that, you were able to get out a little bit earlier before price did what it did. Well, price is what it is, right? I mean, if you see this type of bottoming formation, this is a change in behavior, right? Price is doing something different here. So, probably the best strategy in that environment, if you are on the wrong side of the trade, is to kind of, get into risk management mode and not necessarily flip your bias, right? But at the very least, take risk off the table, or at least start employing a strategy to manage risk rather than add risk, right? The worst thing you can do, if you were short from here, is to start doubling down in adding risk as the market is changing its behavior. And then, of course, people will add risk and just double down as the market rallies. Again, There's no guarantee that that will happen, and you can get away with it now and then. But over a long period of time, if people who do that, they're going to lose their account. It's just this is the way the market works. But anyway, we have this area here, which is the FOMC range, and you can see how I really didn't expect these lows to get ran right here. I actually posted a few videos saying that the low is in following this FOMC meeting. I really didn't expect these lows to get ran, but I also was kind of open to the possibility of it. And that's particularly why I didn't have a stop loss set here. Just because, while I did kind of identify the fact that capitulation had already occurred, and this is, Bitcoin was likely bottoming out, there were a couple break in market structures, right, that you could identify. There was a break right here on the daily. This happened, and then price started running for liquidity below the lows. Then you get a little bit of a temporary breakup on the 4-hour, but then you get the same type of, right, the break of structure we saw on the daily. You kind of have the same type of situation going on right here. You can mark off this low right here. So, while I am very bullish on current price action, I do acknowledge that, this is a fractal pattern playing out. And particularly when I saw this broken, right, this area here, I had a stop loss. I've been in this position, on this long position, since the FOMC, roughly almost a month ago now. And I had a stop loss here, managing a significant degree of that risk. Because this is a break of market structure, right? It's the same fractal concept we saw on the daily chart, just on a 4-hour chart. So when this gets broken, particularly in combined with this run above the highs, when you see liquidity ran like this, and then it tests down and an intermediate low, and then the low gets ran down, this is your break of market structure. When I saw this, I'm thinking, okay, I'm still overwhelmingly bullish on the range to hold at the roughly 18K, 19K level. But when I saw this break of market structure, I thought, okay, well, price is probably going to run for liquidity below the lows. It's going to run for these lows. And you never know. You never know if it's going to run for just this low, right? It ran that low here, right? This could have been the bottom. It could have just ran these lows here and then rallied up. But you never know, right? Ultimately, it ran that low, then this low, and then this low. It ran every low. Of course, not the ultimate low from June, but all the lows from the last month. So it's a good example of how you can form a base, a support base, break market structure on the lower time frames, and then run for downside liquidity without necessarily breaking the range. And that was something in my previous videos I identified. I was like, I have a pretty strong feeling that these lows will get ran. I just don't know which, if it will be all three, if it'll be one, if it'll be two, if it'll be three. You just don't know for sure. And then conversely, when you see this break above, you have this very clear breaker right here. Whenever you see a push down like this, let's see, this area right here, whenever you see an aggressive push, you would expect this consolidation base here to hold. You can mark off the bottom right here. There's a few different distinctions here. So you can mark off what would be this area here, the base, the point of release here, and then ultimately the high of the consolidation, which is right up here. If this were a downtrend, you would expect, some of these levels to hold, right? So really, I would be looking for the middle of the consolidation to hold. But ultimately, when you see this push down and then you see it rally quickly back above these highs right here, that's your trap scenario, right? We can just pull everything off the chart. This is where traders are trapped, right? Um, everyone who was long here got, you know, destroyed. And basically what happened here is, so everybody's sitting around, and I was watching this live. So I was watching the CPI data release come out live when this price action happened. And, basically what happened was you had, well, like, so you had the CPI data release come out, and within like a few nanoseconds, price moved down extremely aggressively. And then, within like less than a second, and then you had people, certain macro gurus and certain people on Twitter, probably were looking at this and saying, okay, well, CPI came in above expectation. The expectation was 8.1. CPI came in at 8.2. So, but of course, they're not as fast as the Wall Street algorithms. So they're only reacting to that news, probably right down here if they're, quicker. But a lot of people, down after the final push. So you have these macro guys shorting here and shorting here. Um, and so of course the Wall Street guys are pouring in before them, and these guys are becoming late shorters using this macro data as confirmation. Well, of course they all pile in, and then price rockets upward. So it's a very very characteristic distinction that you see playing over and over and over. And really, it's a situation where people who are over leveraged. I mean, if you were over leveraged, unless you had a great entry from back during FOMC, if you were opening an over leveraged position at the daily open, you got destroyed, right? The day opened uh, right here, right? Opened at 150 and pushed down 1,000. So a lot of those people got wrecked. But this is a very clear bottoming formation. You got the heavy volume coming in on the daily. I mean, this is very, very significant volume. So you got to keep this in mind that this capitulation here was the highest realized losses ever taken in Bitcoin's history. So this is some very, very significant volume. It would be very difficult to find volume that was more significant than this capitulation right here. So the fact that today's volume is of course it's not higher than this level, but um, it's not dwarfed by this level, right? It's still significant above the average within this range. And the fact that it is, relatively in the same range as this volume profile, that's pretty significant. I mean, you don't usually see that. So it's a strong indication that you are seeing buyers step into the market. They are pushing price up, and ultimately, I think this is when people get into disbelief and they start to kind of come at odds with the market. So this is very early on in if price is going to mount a rally. We're very early on. Really, we've only got a cross on the EMA on the hourly chart. But if Bitcoin is going to mount a rally, then of course that hourly cross will lead into a 4-hour cross. These will cross up. You'll probably see the daily run above these highs right here, and then the EMAs cross up there. And if we go to a weekly chart, it's going to be a while before the weekly crosses up, but uh, it's a very very interesting price behavior we got here. I mean, this is very characteristic of a bottom. Let's see, and you still got this RSI divergence in play. Again, Bitcoin has never seen a weekly divergence on the RSI, and it does look like the weekly stochastics are getting ready to cross up. You got a little bit of a false signal right here as they crossed up right here. But typically this is a good illustration of a basic trading concept, which is that anytime you're coming off like heavy volatility, whenever you see like any price distinction or price signal that is like contrary to that volatility, um, it's generally you generally want to fade that on first pass because it's just really rare that price hits this capitulation bottom and then has a V-shaped recovery. Now, of course, we did see that in March 2020, but that was in a little bit of an unusual time, right? The Federal Reserve printed like $4 trillion. Um, so again, that's kind of very difficult to replicate. Most of the time, following a capitulation, you get these dead cat bounces, and then you get some bullish signals that start cropping up, and you generally want to fade it at first pass. But the mistake is you don't want to make the same mistake at second pass, right? Because a lot of people who successfully faded the first pass, it worked out for them, so they're becoming conditioned to think, oh, I'll fade the second pass too, and generally that's not a good idea. Now, I don't have a scientific reason for why second pass, second, whatever you want to call it, displays of price distinctions are more important than first pass. There's no scientific explanation for that. It's just something I've noticed from years of experience. Um, so take it for what you will, and again, not financial advice, but hopefully you guys get something useful out of this. If you guys do find some value, please make sure to leave a subscribe on the video, and I'll catch you guys in the next upload.